market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, it's jobs day in the U.S. We'll dive into the markets in a moment and talk payrolls, the Fed, and tech with Robert Dishner from Neuberger, Berman, and Katherine Ogundiya from Barclays. But first, Iran says it wants to bar U.S. and Israeli ships from the Strait of Hormuz and require payment from hostile countries to sail through it. Well, European natural gas futures have jumped. Oil is higher as traders, of course, await the U.S. response. Before those reports by Iranian media, the U.S. president was asked about whether a deal had been agreed to reopen the strait.
I don't want to say it has been. It's sort of open right now. You know, we have a thing called the blockade headed up by the U.S. Navy, and we control it. And now we control it, but they can always shoot something. They always have something or drop a mine. I think we're doing very well. I'm involved in the negotiation. I think we're doing fine. It could be said.
Let's get more from Abir Abu Omar in Dubai. Abir, good morning. So conflicting comments from Washington and Tehran. What's the latest?
Good morning, Francine. Yes, conflicting statements yet again from President Trump and the Iranian side. Now, two important caveats in this deal that you had spoken about in your intro. This is according to Iranian media, right? So we don't have the formalized draft that Iran and Oman have been discussing over the past week or so. What we know from Iranian state media is that essentially Iran wants to bar U.S. and Israeli flagged ships from crossing through the Strait of Hormuz, and then it wants to have tolls or charges on ships that it deems hostile. Now, a lot of traders are perceiving this as a sign of Iran saying that it would bar or that it would ensue tolls on ships from GCC countries and their oil exports. Again, none of this is verified. We have to wait for the formalized statement from Iran. It is now with the Iranian parliament, so that is something that is pending for the time being. Meanwhile, you're still seeing signs of aggression in the Strait of Hormuz, Francine. You're seeing the UK Navy that said that it had monitored two ships being attacked, and then Iranian state media also saying that Iran had attacked two hostile ships. We don't have clarity on what kind of ships those were, but we're seeing signs of aggression in the Strait of Hormuz. The threat of Iran attacking ships is still very much there. Meanwhile, of course, President Trump says that he's part of those negotiations, something that Iran has refuted over the past couple of days. And you're also saying that he had remarked that a deal is close. Iran also saying that Washington is not involved in those negotiations that are taking place primarily between itself and Oman to temporarily open the Strait of Hormuz with those contingent lines, of course, that were reported by the state media.
All right, Abir, thank you so much. Abir Abu Omar there with the very latest, of course, on what's happening with the Strait. Now, between earnings season and the U.S. jobs data coming out today, the markets have had a lot of information to digest this week. Joining us now to break down the trends behind the numbers, Robert Dishner, Senior Portfolio Manager for Multi-Sector Fixed Income and Head of Trading for London at Neuberger Berman, and Katherine Ogundiya, Senior Thematic Equity Strategist at Barclays. So thank you both for joining us. Robert, when you look at the Strait, and again, geopolitically, it's unclear what happens, and then you also have quite a lot of pressure on Kevin Warsh just to say more on what he's thinking. Like, what's the state of the markets right now?
Yeah, the market is somewhat, I don't want to say on tenterhooks, but it's a bit of an unstable equilibrium, right? Because they're trying to figure out what the reaction function is. We sort of know if there are second-run effects, the Fed and ECB and other places will hike rates, but they're not exactly sure because they're used to being told what to think. So it's a little bit of a learning session for the markets as well.
Thematically, Katherine, again, geopolitics, the market really latches on to good news or encouraging news, and then it's unclear where we go from there.
Completely agree. We recently published our update looking at global thematic AUM allocation, and we're definitely seeing greater shifts in allocation towards themes which have really got a geopolitical lens. A big focus has been on strategic autonomy, and we're seeing that across all three regions, in addition to a big focus on tech.
So what do you want to hear from the Fed? Or actually, what do you want to, if you had one question to Kevin Warsh, because he's getting quite a lot of pressure from bonds.
He is and he isn't, right? The question is this part of the intended reaction, right? Are we getting tightening of financial conditions as a result from his silence, and is that something that's a feature, not a bug, right? So the question we would have really is, how do they see the economy playing out for the rest of the year? We last got forecast in June. It's now July. There's the difference in June was we had MOU. Now we don't have sort of an MOU. So what does that look like? And today's labor report and next week's CPI are going to be very big inputs into that September decision.
But you think the Fed holds, or does it really depend on the jobs report?
We do think the Fed is on hold. We think the data will support that. However, if the data does turn out to be better, then certainly markets are priced for about a 60% chance of a hike. Those odds probably go up.
Katherine, what's your take on the Fed? And again, actually, when you look at central banks, I mean, it could be Bank of England, the ECB. I mean, the Fed is, of course, the big one that everybody really watches for repricing. But how much is it about central banks and inflation? How much is it on earnings?
I think inflation is critical at the moment. If we're looking at how global thematic investors are prioritizing, looking at the allocation into different categories, inflation is really where it's going on. The interesting thing when we're thinking about global thematic investors is because they're looking across multiple different areas, thinking about consumer spending and where the priorities are. The consumer as sort of a thematic category has been incredibly weak, so the data that we expect to see will be helpful to see this sector move forward.
Yeah, and I understand that also different regions invest thematically very differently.
100%. So if you look at Europe, which is really the heart of global thematic investing, they've got over 50% of global thematic AUM. They are very diversified, looking at everything from materials to technologies to space and the emerging thematics. The US, on the other hand, is very much focused on tech and technology. No surprises there. With a shift into energy as we think about the sort of powering AI thematic. Asia is slightly different, where the big focuses are on structural infrastructure, key materials, and innovative technology.
So interesting. When you look, Robert, at, again, if we go back to the Fed, I mean, there are concerns about jobs, and I don't know whether this is because of AI or something more fundamentally a structural shift.
Yeah, so that's exactly right. What we've seen over the past number of months is a decrease in the participation rate. Right. That's coming both from older people, but also younger people as well. So the question is that AI? Is that something in the data? Is that a structural shift in that? And actually, one of the bigger numbers we're on the lookout for today is the unemployment rate. And the unemployment rate will be dictated to a certain extent whether or not we get a further drop in that participation rate today. So there are structural things that feel like they're at play that are different. And the only other thing we'd note is, if you think about today where 401ks are relative to post-GFC, remember, people were working longer because they had to pay back. They can retire a little bit earlier now.
Katherine, I mean, do you see these structural? I mean, it could be, again, demographics. It's just we should look at the economies maybe differently than we did even 4 years ago.
Certainly, depending on how people are thinking about allocating their capital, but also who's really playing in this market. Yeah. You see this particularly in the US with a lot more of sort of retail investors really shaping how we're seeing it flows into some of these passive thematic strategies, whereas in Europe, to your point earlier, we're definitely seeing a bigger focus on the core traditional thematic categories.
From the fixed income point of view, so tell me what you do with treasuries right now, and then we'll go on to UK and Japan.
Yeah,
it's
sure.
All very there's a lot to talk about.
Exactly. So, for the time being, we like being in shorter dated treasuries.
Right.
There's just concerns on the longer end, even away from some of the concerns that people have noted from the Fed, but we do have U.S. fiscal, we do have some of those other things. So we do see better opportunities in that sort of 2 to 10 year part of the curve. And but again, even if the Fed were to hike twice, a lot of it's already in the price already.
I mean, on yen intervention, were you surprised actually that Treasury got involved?
Yes and no. I mean, they've been sort of hinting at this, but they need something else. But already we've retraced about 50% of the intervention level, right? There, someone put a very good quote. There's a level of yen that fixes JGBs and a level of JGBs that fixes the yen. So, that was, that wasn't mine, but it was somebody else's. But I think that's sort of right. And so they need some more support. So not a surprise. I think the one surprise was why they did it euro versus the yen. And so we're still trying to get some answers around that.
I mean, politically, it might be difficult for the U.S. to actually, use the U.S. currency, right?
Exactly, but that was really sort of the question.
Catherine, overall, I mean, something like Japan, that we've been spending a lot of time talking about it, I mean, does it really factor in your thematic investing, or is it just really like country-specific?
It's a really good question. Japan's quite an interesting case, and it really ties to some of the thematic work that we've been looking at, particularly when it comes to looking at rare earth materials. Investors have really seen the growing focus on securing your own supply chains and seeing the work that Japan has done in terms of thinking about resource resilience, extracting critical raw materials. Namibium has really been sort of the benchmark region as more countries try to shift their supply from China. So that's been a really interesting way that Japan's being looked at.
Let's also talk about tech. And Alphabet sold $25 billion of investment-grade bonds after generous yield payouts helped secure one of the year's largest order books for AI-related debt. Well, Matt Bloxham from Bloomberg Intelligence joins us now. So, Matt, thank you for joining us. I mean, this is a huge, actually, bond sale. It was met with a healthy investor appetite. What does it tell us about AI CapEx spending in general, that people feel more comfortable with it? Maybe.
Not, maybe. I think it tells you something.
Fran, you're way too optimistic.
A little bit about Google and a little bit about CapEx. And what's interesting is the spread over treasuries. So I think that there was a healthy premium here of what you typically expect for Google bond. Yeah. I think I was just looking at it now, and the average spread over treasuries for Google bonds is around 75 basis points. I think for the longest maturity in this new issue, it's about 130 basis points. So quite a big premium. So even Google is having to offer investors more to get funding for its AI capex. But I think on the positive side, I think people still see Google as a key player in the future market. Yeah. Otherwise, they wouldn't be investing in such large size in their debt.
And Robert, are you seeing actually more and more? I mean, there is quite a lot of debt. I mean, it's finding a home. I don't know how is this a good sign, or actually are you just waiting and see?
Well, we do expect further supply from the sector, right? This is one of the biggest stories, frankly, and the story's not going to go away. It started sort of end of last year, and it's going to continue through 2027. And part of this really is when does the cash flow, these companies went from large cash flow positive to now cash flow negative due to the capital expenditure, and when do they flip back to that cash flow positive number? And there'll be some data that support that. But again, the desire and the need for capital for these is somewhat insatiable.
Yeah. But what does it mean for corporate bonds? Again, is that part of when you look at allocating capital? Where do corporate bonds come in all of this?
A little bit of both, a bit of focus. But if we focus maybe more, say, on the equity side, where we're sort of thinking about particularly the sort of allocation of, say, thematic capital, tech makes up about 50% of this allocation. The main issue has been thinking about stock crowding. So actually we're seeing as much of the focus is on this key sort of obvious tech names, investors trying to look at the sort of broader supply chain to get exposure and reduce crowding.
Meanwhile, IPO, like SpaceX is just the most incredible IPO. Yesterday, they released more than 900 million shares from lockup, and the shares went up.
Yeah,
what does it tell us?
I think that was probably more about what happened to the shares the day before when they announced the results, and you had this kind of unexpected view on the capex spending on AI, and so a huge release of new shares. So technically, the free float's kind of gone up to like something like 1.5, 1.6 trillion versus kind of 600 and something billion. It's a massive increase, but the question is how many of those insiders actually sold, or was a lot of this short sellers covering? So some questions there about where the volume came, but because there was a lot of volume in the market and the shares did respond positively to it. But I think to some degree this was about a kind of a bit of a bounce post the kind of results sell-off, and perhaps a lot of retail investors who in the IPO were disappointed in their allocations being able to actually tap into some additional liquidity.
Yeah, and I have to say, when we think about this, a lot of the times of course, it's a tech story, but it's a financial story, just because of the large amount of these IPOs and what it means for markets, and therefore also corporate bonds in the future. I mean, will the market absorb whatever?
The market will absorb. They'll absorb a lot, but for example, right now, given some of the spreads that were just mentioned in the long end, we're starting to see some value in some of that longer end. So while we may not necessarily love long end treasuries, there are some values emerging in some of these long end hyperscalers, and so if that's the case, then that sort of means the market's open. And what we're going to want to see is whether or not there's discipline regarding issuance. As you noted, the order books were very large, and so that suggests suggested there was some discipline around the issuance numbers from yesterday. So we are, it's a daily conversation.
Okay, that's very diplomatically put. Katherine, I mean, when you look, again, tech, I mean, it's AI, it's big data, it's digital infrastructure, it's cybersecurity, it's then all the add-ons. Like, where do you see value?
We see value across all of these areas, but it's taking a step back and not thinking purely about the sort of the key names. And by that, I mean the big play, the big trade at the moment is clearly the powering AI thematic. From our perspective, looking beyond the tech names, trying to get exposure to, say, the water cooling, the data center cooling companies, thinking about the core infrastructure that is required as we see this sort of CapEx spend. Where is it going to be deployed? That's where we see sort of opportunities around the fringe.
Do you see it the same way, Robert? That actually it's kind of the I guess, AI adjacent?
Yeah, no, we're seeing a lot of these deals already. So it's in securitized space and some other parts of the market. So yeah, there are a lot of add-ons, if you will. Well put.
Yeah. And then, Matt, I mean, everything's changing so fast because also OpenAI came out with its first consumer tech. Can you, what is it?
Yeah, we're still, they're still waiting for the actual product to kind of hit, and it's also kind of Bloomberg exclusive to some degree on what this might be, a $300 to $400 home speaker. A kind of fairly crowded market across all the major tech players. So it's going to be interesting to see what it has that's novel enough to draw people in, because it's quite an expensive speaker compared to what you can get from the likes of Google or Amazon. Pitches it at very much the premium end versus Apple, who they're obviously in a big lawsuit with. So I think it's going to, and also it's going to be a way to try to kind of draw people towards the Chat GPT product away from other AI assistants. So it's going to be interesting whether it's got anything in it that's novel enough to kind of really pull people towards it. It's talked about it being a kind of a hockey puck-sized donut with a few kind of moving parts, and maybe that's going to be innovative enough to kind of bring some curiosity in. But that market's pretty well established in terms of the home speaker market. So it's hard to see that it's kind of really changing the kind of or creating a new product category, if you like.
So Matt, I mean, is there a danger that actually have these mega companies all going for the same segments because they just need to make money? And
I think we've seen that probably over the last 5 or 6 years. Where each company, these big tech companies had a much clearer domain that they controlled because the market's got more competitive, because growth in those markets slows. They're encroaching on each other's, and now you have all these big tech players that largely look a lot like each other, and they're getting incredibly vertically integrated.
Thank you all for a terrific panel. Matthew Bloxham there from Bloomberg, as well as Robert Dishner, Senior Portfolio Manager for Multi-Sector Fixed Income at Neuberger, Berman, and Katherine Ogundiya, Senior Thematic Equity Strategist at Barclays. Now, coming up, a profit beat for the world's oldest bank as Monte Paschi faces a takeover bid by rival Intesa Sanpaolo. Details next, and this is Bloomberg. Italian bank Monte Paschi has exceeded profit expectations in the second quarter. Now, the earnings beat provides a tailwind for the chief executive, Luigi Lovaglio, who, he considers how to respond to a takeover offer from rival bank Intesa Sanpaolo. Now, we're now joined by Stephen Ahrens, who leads our EU finance coverage. Steve, no rest for the wicked. I mean, there's always something new. What are the key takeaways from the earnings?
Well, the key takeaway from this set of earnings is that they didn't really say much about the way forward. They, they beat on profit, which is great. The stock's up a bit. And Luigi Lovaglio, the CEO of Monte Paschi, is doing a pretty good job at the bank. He recently bought Mediobanca, another Italian bank, and it's integrating well. So that is all going well. But the big question he's facing is what to do about a takeover offer from Italy's biggest bank, Intesa. And he didn't really say much about that.
What's the latest on the takeover story?
So Intesa has tabled an offer that's valued the bank at about 36 billion, Monte Paschi. That's pretty much in line with the market capitalization, and that's going to go to investors at some point. Lovaglio was actually hoping to sort of see off that bid by trying to merge with another Banco BPM, but Banco BPM withdrew that proposal last week, and so that option, that potential path against Intesa fell away, and now he's sort of left without a really good option to see off the Intesa bid, and all he can do for now, I guess, is try to boost the share price to make it more expensive for Intesa to buy Monte Paschi.
Steve, thank you so much. Stephen Aarons there with the very latest, of course, on Italian banks. Now, Apollo has agreed to buy UK budget carrier Easyjet for £5.7 billion in a deal likely to shake up the European airline market. It comes after rival bidder Castlelake said it was pulling out of the chase. Let's bring in Bloomberg's aviation reporter, Danny Lee. Danny, good morning. So talk us through the events of the last 24 hours with the Castlelake bid cancelled and Apollo set to take off.
Yeah, good morning, Fran. Clearly, there's no shortage of drama as well in the European airline space as well. The fact that Apollo trumped Castlelake coming in earlier in the month with its own last-minute bid to take over Easyjet with the support of management, a higher offer. Clearly, that proved to be a higher offer too far for Castlelake at the end of the day. And very much different proposals, in a sense, put on the table, and particularly the speculation that Castlelake would look to potentially break up the budget carrier. For Apollo, no, at least it's looking to support management with its growth and potentially accelerate the levels of growth it's looking to pursue and also the levels of profitability. It does believe it can create more value by supporting the management and doing a lot of the growth and expansion in private, away from the shareholders and away from demands to do things in a much quicker way than maybe someone like Easyjet can do. And of course, the fact that Easyjet has been under pressure for some time now, and particularly as you have seen with its share price falling, the fact that it is now going to be hopefully soon in private hands as well. So yeah, very much two different dynamics, and Apollo there, the victor.
Danny, what does this mean for the future of Easyjet, but also for the highly competitive European aviation market?
Well, for Easyjet, it now potentially has a very well-funded owner that can really help support it in a much, much bigger way. The fact that it has around 350 aircraft, it's in a lot of these major European airports as well. Some very attractive assets it has. The fact that it can now be put to work, and even though it has a different business model to the likes of Lufthansa and Air France KLM, it really could put an even bigger challenge. And the fact that Apollo has highlighted the fact that it could use bigger planes and really double down on a lot of the routes where it feels it can create more value. Yeah, the fact that there could be a challenge for the legacy airlines and also for other low-cost giants like Ryanair and Wizz. So therefore, it's potentially a new evolution for Easyjet in its growth story, and one that can be put to use with the likes of Apollo.
Danny, meanwhile, the U.S. aviation regulator has asked operators of Boeing 737 MAX jets to undertake checks for component cracking. So what more do we know?
Yeah, this is a component that is around one of the door frames of the 737 MAX. And so there is some cracking around that, and therefore the FAA does want operators of some 471 jets to just undertake some checks and see whether there may be implications for the fuselage. And the risk is that with this cracking, it could undermine the structural integrity of aircraft. So as a precaution, the US regulator does want these checks to be done. And this is all being done with support of Boeing as well. So not too much of a cause of concern, but at least one that they want inspections done as soon as possible.
Danny, thank you so much. Danny Lee there with the very latest, of course, on transport. Coming up, our exclusive conversation with the chief executive of defense giant Rheinmetall. We discuss the loss of a multi-billion-euro German naval contract. We'll also discuss much more. That's coming up next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Tensions resurface. Iranian media say Tehran is looking to bar U.S. and Israeli ships from the Strait of Hormuz as reported strikes push energy prices higher. Traders turn their attention to the U.S. jobs report as they grapple with continued silence from Fed Chair Kevin Warsh. Plus, Alphabet sells $25 billion of investment-grade bonds in one of the year's largest order books for AI-related debt. We'll get the latest on tech. Now, oil has erased some of the declines from earlier in the week after reports of strikes by Iran in the Strait of Hormuz. Let's get more from Will Kennedy, our EMEA news director. Well, I mean, it's just unclear, frankly, what exactly is happening. So another volatile week for this elusive deal.
That's right, but prices are only a little bit above $80 on Brent and below that for WTI, and these are not very high prices in the context of the war and what we've seen this year, and I think that probably reflects an underlying feeling that there will be some kind of deal that allows more oil to escape from Hormuz in the coming weeks, and also that despite everything, the global crude market remains fairly well supplied. Where there is more tension is in the global product market, what people are paying for diesel, gasoline and jet fuel, and those prices do remain very high. So oil is not that high, but it will have an impact on the economy through those product prices.
I mean, it's impossible to know what happens, but actually it's also geopolitically impossible for the U.S. to take the deal as it is.
That seems to be right, and the negotiations seem very slow. What we don't really understand are the deliberations inside Iran, the different factions inside Iran, how much hardline voices inside Iran are really pushing for a deal that the U.S. cannot accept. It's slow going. Earlier, Trump said this week that it would be within 48 hours. That hasn't happened. We'll wait to see what happens today and over the weekend. But I don't think anyone's expecting a flood of shipping through the Strait anytime soon in the coming days.
We've also seen European natural gas rising.
That's right, and I think that reflects a concern about the coming winter. When the Strait was briefly open a couple of months ago, a few weeks ago, there was optimism that Qatari gas would be able to get out and help replenish European supplies stockpiles before the winter. That prospect has dissipated a lot. Stockpiles in Europe are in the sort of 50-something% range. You'd normally expect at this time of the year to be higher, perhaps 70-something. And as we get closer to those winter's months, if we don't see those flows of LNG, there will be concern that Europe's going to have to spend a lot of money buying LNG through the winter, which will bring up energy prices across the continent.
I mean, in general, when you look at oil, how has it been moving actually from the Gulf during the Hormuz closure?
So it is escaping. Not at the volumes we would have seen before the war, but perhaps at volumes that are higher than people expected. And it's happening in two ways. Those pipelines, both through the UAE and through Saudi Arabia to the Red Sea. Despite the Houthis, that oil still seems to be flowing. And then we are seeing some oil come through the Strait of Hormuz itself. It's hard to detect because the ships are going through dark with their transponders turned off, but there does seem to be these shuttle runs which are getting some Emirati oil out as well. So there is oil. It's not a complete blanket. There's probably Iranian oil getting out as well. And as I said, the crude market globally isn't enormously stressed right now, but products markets are a little bit more so.
Well, thank you so much, as ever, for joining us. Will Kennedy, they're our EMEA news director. Now, unusually low river levels across Europe are also disrupting trade, forcing curbs to nuclear power generation and exposing how vulnerable the region's infrastructure remains to increasingly frequent droughts. Many companies are falling back on workarounds to prevent larger disruptions, but they also may struggle to do so if levels drop further. Well, levels, for example, on the Rhine, one of Europe's most important trade arteries, have fallen to their lowest on record. We're now joined by Rico Luman, a senior sector economist for transport and logistics at ING's. Rico, thank you so much for joining us. Now, at the moment, certain ships can actually still pass through the Rhine. If it stays as dry, do you think there will be a point where transport is just no longer possible?
If we look at where we are now, extreme lows, capacities are reduced to, let's say, 20-25% when sailing to the upper Rhine. Well, you can always sail on the Rhine, but load capacity will reduce further if we go down further in water levels. So that's what will happen over the next couple of weeks if nothing changes.
Rico, overall, what industries do you think are more and most vulnerable to prolonged lower water levels?
Yeah, if we look at what is being transported on the Rhine, it's particularly mineral oils, chemicals, raw materials such as iron ore and coal, but also containers. And well, the first package of liquids is maybe most vulnerable because those shipments are also sailing to the Upper Rhine, to regions like Ludwigshafen and Karlsruhe. Which are limitedly available and reachable at this point because you need to cross Kaup, which is a choke point on the Rhine. So these raw materials and liquids particularly are most vulnerable. If we look at containers, they can easily be shifted on rail or on the road, on trucks. So these products and these goods are more easily transported by other means and by other ways.
Rico, I mean, what are the, I guess, sectors that can cushion some of the disruptions by, for example, relying on inventories?
So if we look at the impact, industrial sites are most impacted, right? So we're talking about companies like BASF or ArcelorMittal, ThyssenKrupp, so the steel manufacturers, but also other manufacturers. So it's a massive cluster which is located on the banks of the Rhine. So it's quite an impact, and we have seen several companies already announcing production curbs on as a result of this. So we will see impact for production and also for economic development as a consequence of this.
Rico, are there any measures that politicians or companies can actually, take now to make it a little bit easier?
Yeah, it's not that difficult because we're dealing with raw materials, so that's massive volumes, right? So it's very difficult to shift these to other modes. And often it's also a matter of location on the water side. So that's not reachable by other means. So yeah, when we look at this, it's a matter of just building up more buffer stocks in the future. But that's something for the future, right? So that's not a detour for now. So now it's a matter of trying to get more barges on, to just transport more on these barges. And then for the future, we will have to look into infrastructure adjustments and also adjustment of the Rhine infrastructure.
I mean, does recurring low water change this really, the long-term role of inland shipping? Do you think trades and actually routes will have to change in the coming years?
Yeah, the problem is really these volumes, because these volumes are massive, right? So it's not easy to put this on trains. We can't easily do this. There's not enough capacity available and not near enough. So that's not really a solution. Yeah, we will need to look into other options and alternatives to deal with this and to turn more resilient, because this is going to happen more often than in the past. We've seen it twice now over the last 10 years, and now again. And this is already more than in the last 50 years. You can imagine that climate change is going to have an impact even more in the future on the Rhine. So we will need to prepare for this, and that's also a message to policymakers.
I mean, again, are there actually, when you look at the next couple of months and quarters, what are the industries that you worry about the most? I know we talked to the ones that are most, vulnerable, the ones that have inventories. It just feels like it just adds on another point of pressure, given what we're already seeing with, the Strait of Hormuz.
Absolutely, yeah. It comes on top of other disruptions that we have across the world, particularly the Middle East and Hormuz disruption, which impacts energy markets, of course. But more structurally, the competitive position of Europe is in play as well. If we look at companies like chemical industries along the Rhine or steel production, this is also one of the things that's important for choosing a location to invest in. So it really matters.
Rico, thank you so much for joining us. Rico Luman, they're Senior Sector Economist for Transport and Logistics at ING. Now, Rheinmetall has cut its sales forecast for the year after losing a German naval contract worth billions of euros. Germany's biggest defense company has positioned itself as a key provider of weapons to Europe. It's now seeking to secure additional contracts for its naval division. Now, we spoke exclusively with the chief executive, Armin Papperger, about the loss of that naval deal and what's next for the company.
I am very unhappy that we lost the F-126, but at the end of the day, there is an impact, but it's not a huge impact. The naval business is at the moment the smallest business of Rheinmetall, and we will have an impact this year of about 300 million euro in sales. Mm-hmm. This is exactly what we took out also from our guidance. But this business is on a level of 10%, so between 20 and 30 million, with an EBITDA of 3 billion. So you see the impact is very small on the profitability.
Could this actually lead, though, to a slowdown of the production ramp-up?
No, not really, because we have such a wide product portfolio that I'm sure that we can, over the next years, compensate or overcompensate also these areas. We are fighting hard, and I have a great team, and the people compensate a lot. So we stay on the expectations, and for next year and also the years after next year, my expectation is that the growth rate is still more than 30% per year.
So what exactly will compensate for this loss of contract? Is it autonomous vessels? Is it smaller boats?
This is one point. On the other point, we are looking for international and other national contracts. And I'm sure that also Germany will give us some contracts, because we have the biggest shipyards over water here in Germany. And Germany needs these capacities, and I'm sure that we will find a good way.
Have there been any developments on your bid for the German naval yards?
We gave a non-binding bid on the German naval yard, and at the moment I can make no decision, because I have to wait that we get more contracts. With the F-126, it was a need. Therefore, that was the reason that we gave this bid. Now we have to wait, and we will see over the next 2-3 months if there are new contracts coming in, and if yes, then we will continue.
Do you worry, sir, that actually there are other things like the frigate F-127 that will be called into question by German lawmakers?
I have no idea at the moment what really is coming with the F-127, because the German government at the moment is looking forward to say, okay, we have to reduce the cost structure. And we are in negotiations at the moment. You know that we are in a consortium with TKMS on the F-127, and we want to do what is good for the customer at the end of the day, but we are also flexible.
I mean, Germany appears to have also decided to open the tender up to others for the procurement of the collaborative combat aircraft instead of going with the Rheinmetall Boeing product from the start. What do you make of this?
Competition is always good. Germany is looking at the moment for different solutions, and at the end of the day, the best solution should win. We go with Boeing Australia in that area, because we believe that this system at the moment is a modern system, and is the most qualified system at the moment. But it seems to be that Germany wants to go like on the drone business with 2 or 3 different competitors, and that's really good, and that's fine for us.
But what does it mean for you? Are you still confident that you will be given the order?
I think that the order will be first split. to have a pre-phase order. And then at the end of the day, the winner takes it all. And I'm always convinced, if I'm not convinced that we are able to win, I should not go into a competition.
I mean, that's good life advice in general. Now, by collaborating with Boeing, it also means that you're no longer developing this collaborative combat aircraft with Anduril. Are you working with other things still with Anduril?
Yes, we spoke with Anduril about different things. We didn't find on the Fury a final decision in this area. That's the reason that we stepped in with Boeing. But I'm always very open with corporations, also with Anduril. At the moment, we have no product that we can sell immediately, for example, to European customers.
But what does that partnership look like? Do you have any concrete ideas in your mind of what you could be developing with Anduril?
Yeah, usually we use we develop our own stuff, but usually we use technologies which are ready. Because Europe at the moment is looking to have ready products and not is looking to have huge development products. And if you see the ministers of NATO in Europe says, okay, let's go forward and let's deliver. So we must be ready with our deliveries in 2029. So I have not a lot of time to develop. I have to implement technologies that partners have ready.
Could you give us an update on the state of the large Arminius contract?
Yes, sure. The Arminius contract will be in the second week of September. There will be the final negotiation on the contract. The German Parliament should make a decision beginning of December, and also in December, the contract should be signed. So the first contract for Rheinmetall will be on the level of fixed contract on 12.4 billion. There is also a service contract for Rheinmetall of 2 billion. This is add-on, so we speak about 14.5 billion euro, and that's a huge contract. And then there are options. There is an option 1 and an option 2. This is up to 35 and also up to 40. So it's a very, very long-term contract. If the government signs also that options, it would be what we always expected, nearly 40 billion euro.
Well, that was the Rheinmetall CEO, Armin Papperger, speaking to us exclusively. Now, coming up, we look ahead to July's U.S. jobs report due later today with Ven Ram from our MLive team. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
The labour market backdrop still pretty decent.
When you take a look at wages, when you take a look at the JOLTS data today and the quits rate, that's going to matter.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market seems okay.
We don't see any wage pressures in the economy.
We're all building up to one thing.
The July jobs report, today on Bloomberg.
Welcome back, everyone. Now, this is a pretty incredible story. North Korea's Kim Jong-un may be isolated politically, but Bloomberg Economics estimates his family raked in as much as $22 billion between 2022 and 2025, despite a slew of sanctions. That windfall is a focus of a Bloomberg Originals documentary.
North Korea. It's a bit of an enigma. A sealed-off society on the doorstep of a global superpower. A minuscule economy, but a nuclear arsenal that commands global attention. And despite a mountain of international sanctions designed to crush it, the Kim regime has begun to thrive.
The entire North Korean government is in stronger position than at any point over the last 35 years.
Following a brief surge in 2016, crippling UN sanctions and pandemic lockdowns sent the economy into a prolonged slump. But by 2023, something changed and the regime oversaw rapid GDP growth.
North Korea's trade and overall regime revenue sources have shifted significantly. A rich North Korea has the potential to be a much larger threat.
If the world once viewed Kim Jong-un as the lonely dictator of a hermit kingdom, his recent schedule tells a very different story.
This is an amazing comeback story for leader Kim Jong-un. We're seeing him more powerful economically, militarily, politically than ever before.
His newfound cash is funding a massive military build-up and the Kim dynasty for another generation, potentially in the hands of his young daughter. So how did one of the most isolated, heavily sanctioned regimes on Earth pull off a multi-billion-dollar economic turnaround?
Well, subscribers can watch that documentary in full right now on the terminal and at Bloomberg.com. Now, we're looking ahead to July's U.S. jobs report later today. Economists polled by Bloomberg expect hiring to accelerate to over 80,000 and the unemployment rate to hold steady at 4.2%. The data comes as markets also face a lack of guidance from the Fed chair, Kevin Warsh, but a number of officials have said action may be needed to tackle inflation. Let's bring in Ven Ram from our MLive team. So, Ven, great to speak to you. Happy Friday. Plenty of cautious Fed speak this week. Kevin Warsh still avoiding forward guidance. How does that change the setup for the jobs report?
Morning, Francine. Great to be talking to you. I think that, the markets are looking for an improvement in the number from over June. But what I'm personally interested in is the actual number for June, because I think that the markets were disappointed last month because the number undershot expectations. But if there is going to be an upward revision to that number, and a significant one at that, I think that the markets will firm up conviction towards a rate hike. And at the moment, the markets are thinking it's going to be a rate hike either in September or October. But if the markets bring it forward, then obviously that will have implications for treasuries. As you mentioned, there's no forward guidance coming from Warsh himself. But if he stays true to his previous pronouncements that look at running inflation hot is a choice, then it's logical to expect that the Fed will be hiking rates soon.
Ven, the yen has also given up nearly half of its intervention-driven gains. So, why has this happened? And could we actually see authorities step in the market again?
Well, I think if the reaction to what we have seen so far is anything to go by, I think that the authorities may think, is the risk reward worth it? Because, the yen has advanced all of 0.5% this week for all the pyrotechnics that we had at the end of last week. And it's drifting back towards those weaker levels, so which is not what they want to see. In fact, if you look at all the previous 5 interventions in the dollar yen, I think in the 1 month after that intervention, the dollar yen has had little to show in terms of gains in the yen. So I think that, the point of this repeated intervention is lost on the markets. What they need to do is to raise rates sensibly and at a faster pace. And until that happens, I don't see how the yen is going to turn around its fortunes.
Ven, thank you so much, as always, for joining us. It's going to be a big day at the end of a big week when it comes to, of course, the U.S. jobs data today. Ven Ram there from our MLive team, of course, with all of the things that we need to watch out today, but also into next week. This is a picture for U.S. equities across the board. Look, they're a little bit muted. European indices also muted before the U.S. jobs data, but also gaining. Oil is gaining as prospects for a lasting agreement to reopen the Strait of Hormuz seems to be pretty elusive. I'm looking at Brent. It's at $83 a barrel. You can see the CAC 40 gaining a touch. It's nothing huge. They're kind of, I guess, in a wait-and-see situation. Also, because of that key monthly U.S. payrolls report. Up next, Bloomberg Brief, and this is Bloomberg.